The market is in a precarious state, teetering on the edge of decline, and a scandal is further destabilizing the situation. Investors are grappling with uncertainties as the odds for a rate cut in March have taken a significant hit. Amidst this turbulence, an opportunity for free live trading training arises, but it's overshadowed by the grim economic indicators. The 10-year government yields have breached the 4% mark, signaling a shift in the financial landscape. Meanwhile, the dollar is perilously close to its pre-December FOMC meeting level, adding another layer of concern. The Federal Reserve President, Waller, has made statements hinting at potential rate reductions later in the year, but the immediacy of the situation remains uncertain. In the energy sector, Occidental Petroleum's CEO is painting a bleak picture, predicting an actual oil shortage in 2025. This forecast, if accurate, could have profound implications for global economies and energy markets. Goldman Sachs, not one to understate risks, suggests that the market gamma flipping below 4,750 on the charts could lead to increased volatility. This technical indicator is a red flag that demands attention, as it hints at a potential unraveling of market stability. Adding to the unease, the VIX, commonly known as the Fear Index, has surged by 9%. This uptick in volatility reflects the growing anxiety among investors about the market's future trajectory. The roller coaster ride appears far from over, and the Fear Index is a stark reminder of the fragility of current market conditions. Digging deeper into the economic landscape, a concerning revelation emerges. Government employment, while seemingly a stabilizing force, accounts for a quarter of new jobs. This statistic masks a private sector recession that is being overshadowed by the scale of public sector hiring. The illusion of economic stability provided by government jobs is preventing an immediate recession, but it comes at a cost. The reliance on government employment is not a sustainable solution. While it might stave off an immediate downturn, it contributes to long-term economic challenges. The private sector, the true engine of economic growth, is struggling in the shadows, and the consequences are far-reaching. The government's role in job creation may be a temporary band-aid, but it's not a cure. In the face of these challenges, there's a growing chorus advocating for reduced government spending. The argument is clear: continued reliance on public sector employment to prop up the economy is a dangerous game. It may delay the inevitable, but it doesn't address the root issues. The call for fiscal responsibility is not just about avoiding immediate economic pitfalls, it's about safeguarding the future. The concern extends beyond the immediate economic indicators. It's about recognizing that the current approach is akin to kicking the can down the road. We may avoid a recession today, but at what cost? The ballooning government employment is creating a skewed perception of economic health. It's time to confront the reality that true economic resilience lies in a vibrant and robust private sector. The current market conditions demand decisive action. The scandal shaking investor confidence, coupled with the dwindling odds of a rate cut, paints a grim picture. Investors are on edge, and the free live trading training, though timely, may feel like a band-aid on a much deeper wound. The rise in 10-year government yields is a stark reminder that the financial landscape is evolving, and not necessarily for the better. The breach of the 4% mark is a signal that demands attention. It speaks to shifting investor sentiments and a re-evaluation of risk across the board. As the dollar inches closer to its pre-December FOMC meeting level, the vulnerability of currency markets comes to the forefront. Currency stability is a cornerstone of economic health, and any fluctuations in the dollar can have far-reaching consequences. The Federal Reserve's cautious stance, as indicated by President Waller, may provide some reassurance, but it falls short of offering a concrete plan for navigating the storm. In the energy sector, Occidental Petroleum's CEO's prediction of an oil shortage in 2025 is a jolt to the system. This is not a mere fluctuation in oil prices, it's a forecast that could reshape the global energy landscape. The implications for industries and economies heavily reliant on oil are significant, and prudent planning is essential. Goldman Sachs' warning about market gamma flipping below 4,750 adds a technical dimension to the concerns. The intricacies of market dynamics are not to be underestimated. A breach in this threshold could trigger a cascade of events, leading to heightened volatility. It's a call for vigilance and a reminder that market stability is a delicate balance that can be upset by seemingly minor shifts in technical indicators. The VIX's 9% surge underscores the growing unease among investors. Fear is palpable, and it's reflected in the index that measures volatility. The climb in the fear index is a red flag, signaling that the market is in a state of flux. It's a call for risk management strategies and a reminder that complacency is not an option in these uncertain times. The revelation about government employment obscuring the private sector recession is a wake-up call. While government jobs provide a temporary reprieve, they do not address the underlying issues. The private sector is the heartbeat of the economy, and its struggles should not be hidden behind the facade of government hiring. It's time to reevaluate our economic strategies and focus on sustainable, long-term solutions. Advocacy for reduced government spending is not a call for austerity for its own sake. It's a recognition that the current path is unsustainable. Relying on the public sector to mask economic challenges is a short-sighted approach that sets us up for future crises. Fiscal responsibility is not just a buzzword, it's a fundamental principle that ensures the health and resilience of our economy. In conclusion, the market is at a crossroads, grappling with a scandal, declining odds of a rate cut, and a series of ominous indicators. The economic landscape is shifting, and the need for decisive and forward-thinking action is paramount. Whether it's the surge in 10-year government yields, the looming dollar instability, the energy sector predictions, or the technical warnings from Goldman Sachs, each aspect demands attention. The time for complacency is over, and a recalibration of economic strategies, including reduced government spending, is the need of the hour. The stakes are high, and the choices we make today will shape the economic landscape for years to come. Please go ahead liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.